Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report so complex it's like trying to solve a Rubik's Cube blindfolded. Get ready because we're decoding VS Trust's latest quarterly report. This report's all about how two exchange-traded funds, SVIX and UVIX, are doing. These aren't your average investments. They play with volatility, which can make things exciting, or really not. We're talking potential for big gains, but also big losses, all tied to the VIX, an index that measures market volatility. By the way, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. First off, this is a Form 10Q, which is a quarterly report that companies file with the Securities and Exchange Commission, or SEC. It's a snapshot of their financial health operations and anything important that happened in the last 3 months. This one is for the period ending March 31, 2025. Let's jump into the numbers because that's where the real story is. For SVIX, the net asset value per share is about 2030 is what each share is worth based on the fund's assets minus its liabilities. UVIX had about 14.1 million shares outstanding, while UVIX had around 4.6 million. More shares doesn't necessarily mean better or worse. It's just a reflection of how the fund has been operating and how many shares have been issued. Now has had about 14.1 million shares outstanding, while UVIX had around 4.6 million. More shares doesn't necessarily mean better or worse. It's just a reflection of how the funds are structured and what they're trying to achieve. This is what each share, about 14.1 million shares outstanding, while UVIX had around 4.6 million. More shares doesn't necessarily mean better or worse. It's just a reflection of how the fund has been operating and how many shares have been issued. Digging deeper into how these funds performed, SVIX actually saw a decrease in net assets due to its operations of about $32. This means that after all the trading and expenses, the fund lost money. UVX, on the other hand, saw an increase of about $81 million. Right away, you can tell they are very different financial instruments with very different risks. Now, every fund has expenses, and these can eat into your returns. SVIX had about $857,000 in management fees, while UVIX had around $760,000. This is what they pay the people managing the fund to make all the investment decisions. When you compare this quarter to the same time last year, you can see that fees for both funds have increased. Let's take a quick look at what these funds actually hold, which impacts how they make or lose money. SVIX's short-term investments are around 38.5% made up of things like money market funds. These are generally safe and liquid, meaning they can be easily bought and sold. UVIX has slightly more of their assets in short-term investments like US government obligations fund, or about 39.1%. The remainder for each are derivatives which carry much more risks, as we will soon see. Both funds primarily invest in CBOE volatility index futures contracts. Think of these as bets on whether volatility will go up or down. The type and the amount of these dictate where the fund is headed. So UVIX will do better if volatility decreases, and SVIX will do better if volatility decreases. SVX saw a net cash provided by operating activities of around $16.8 million, while UVX saw almost $78 million. This shows that UVIX is able to convert its assets to cash way more than SVIX, but remember, this is only for the last 3 months. Now, this is where things get a little technical. There's something called a fair value hierarchy, which is basically a way to rank how reliable the values of their investments are. Level 1 is the most reliable based on actual market prices. Both funds mostly hold level 1 assets, which is a good sign. It means their values are pretty transparent. It's interesting to see how these funds use cash. SVIX has about $16.8 million cash coming from its operation. However, there's an adjustment to reconcile net income to this that significantly decreases it. What we can learn from this is that IEIC's cash flow comes from a net increase of assets. Here is the most important part. Time to talk about all the things that could go wrong. A big one is correlation and compounding risk. What this means is that these funds are designed to perform a certain way on a daily basis, not over longer periods. So if you hold them for more than a day, your returns might be very different from what you expect because of something called compounding. This is just the cumulative effect of applying investment gains and losses and income to the principal amount invested over time. It's similar to if you reinvest a dividend on a stock. Now imagine the stock has very volatile swings. Well, you don't know what the dividend will be. All of this means there's risk involved. This can particularly effect of applying investment gains and losses and income to the principal amount invested over time. It's similar to if you reinvest a dividend on a stock. Now imagine the stock has very volatile swings. Well, you don't know what the dividend will be. All of this means there's risk involved. This can particularly affect UVIX, with it being 2x or twice as volatile as SVIX. Another risk is counterparty risk. This is the risk that the other party in a financial contract, like a swap agreement, doesn't hold up their end of the deal. If that happens, the fund could lose money. They try to avoid this by dealing with big, reliable financial institutions. Liquidity risk is another one to keep in mind. This is the risk that they can't sell their investments quickly enough without taking a hit on the price. Contango and backwardation risk refers to how futures prices are structured. A lot of these ETFs roll or replace one expiring futures contract with another later one. This can come with risks. New laws and regulations regarding derivatives trading could change things. What's legal today might not be tomorrow, and that could impact how these funds operate. For example, the Dodd-Frank Act brought in a host of rules for derivatives. Finally, the report mentions that everything stated is as of when the report was issued, and management is unaware of any events after this that may materially impact the fund. I think this may have been the most complex thing I have decoded on this channel. It can be a headache to understand these financial entities, their risks, and their future. Now, looking at the fund more broadly, SVIX has a lot to make up because, as of this report, it is losing a lot of assets. UVIX is seeing increases in operation, but comes with increased volatility. Both funds face regulatory and counterparty risks as well, but the primary risk is the nature of these instruments because of their day-to-day structure. They will be extremely volatile. Alright, that's our breakdown of VS Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.